You are about to learn the most consistently profitable trading strategy that I know of. By the end of this course, you will learn how to set up this trade in a way that makes it nearly impossible to lose money. As long as we short when volatility is high enough relative to the type of market we're in, we should always be rewarded with a lower level of volatility if we wait long enough. In most situations, volatility will decline immediately. In others, volatility may go higher temporarily before eventually coming down. In this course, we'll be focused on the two most heavily traded VIX ETFs, the VIXY and the VXX. Both of these are exchange-traded products, which means they trade on an exchange under a symbol, just like a stock. So if we take the VXX, for example, and graph it versus the VIX, we see a huge divergence over the last 3 years. You can see that the baseline of the VIX is nearly flat over time, while there's an enormous decay in the VXX. If we graph these over the last 5 years, the divergence is even more dramatic. Again, we see the VIX with a nearly flat baseline, while the VXX has decayed essentially to zero. This decay is the second factor that gives us a huge additional edge in this trade. The reason for this decay is extremely important to understand if you want to trade these ETFs successfully, and if you want to understand the risk involved in trading them. We'll cover this in one of the next lectures. And once you understand the components of these ETFs, you'll understand this decay and know what to expect in different types of market environments across various levels of volatility. So when we initiate our short position, we're looking to profit from two fundamental factors that give us our edge. One, that periods of high volatility always decline eventually, as whatever crisis that caused it is eventually solved or mitigated. And two, volatility ETFs decay over time. Because we will be selling these short, we look to profit from both of these two factors together.